now let's see what Bloomberg's #1 ranked unemployment forecaster thinks. John Herrmann is the senior fixed income strategist at State Street Global Markets, and he joins us now. John, let me first get your take. Thanks for joining us. Let me first get your take on the number here, because you are the most accurate labor forecaster that we track, and yet you were more optimistic than the outcome. Why is it? What did you miss in this report?
So, basically, here's what really surprised me in this report. We just heard one of your reporters convey that the private sector produced 71,000 jobs, an improvement over June. But if we look beneath the headlines and we look at the details, what we can see is this. If we just strip out manufacturing, the contributions from manufacturing and the contributions from another sector, education and healthcare, if we just strip out those two sectors, then we can see for the last 3 months, the rest of the private sector, which is 71% of the private sector, did not create a single job and actually shed a few thousand jobs. So, and since the job recovery began in November 2009, actually that collection of the private sector has only averaged job gains around 22,000 per month. Now that is very, very tepid, very anemic, and if I was a Fed policymaker, I'd be very troubled by that.
Well, would you be troubled enough to be addressing this next week? Is this enough to say, okay, let's talk about QE some more?
I think they're definitely going to be talking about it. Whether they choose to announce it at the August 10th meeting is another issue. Ben Bernanke, what he tends to do is not overreact to things in the very near term. He tends to watch things very carefully, and then he acts very forcefully. So that's what I think he may do. But I certainly think the minutes will be describing at that meeting will be describing how intently the Fed officials are figuring out and strategizing exactly what form of QE, going forward, what form of QE should it take?
John, what do you think the best form it could take would be? I mean, what would your prescription be?
Well, from our standpoint, there's very few mortgages being created right now, and the mortgage market is extremely bid, and spreads there are tight. So I'm not sure that all this, purchasing of mortgages going forward may be the right antidote for the problems we have. So, if you do something where you reinvest the maturing agency debt and the coupons and the maturing mortgage paper, if you reinvest it actually in Treasuries, you may get a bigger bang for the buck, because you'll just set off a whole wave chain reaction throughout all of fixed income markets, not just a sort of narrow market.
All right, John, we were talking before about what you would recommend as far as quantitative easing for the Fed. You say that there are not many mortgages being created. There isn't a lot of lending going on. It's been an ongoing problem. How would you address that, and is it really at the heart of the issue here?
Lending conditions in the mortgage market remain extremely tight. So, again, and mortgage rates are at historic lows. Spreads are very tight as well. So, it just really is a question of how much bang for the buck will the chairman get if they reinvest the maturing paper back into the mortgage market, as opposed to investing it in the Treasury market and then setting off a chain reaction of credit spread tightening throughout all fixed income markets. And I think that avenue definitely gives you the biggest bang for the buck.
So you think basically that we could be wasting money if we attempt certain kinds of quantitative easing?
In certain forms, you would just be basically not, you could be pushing on a string and not really getting the kind of leveraged outcome that you would hope to achieve. So I think, we should be basically spreading, firing more of a shotgun type approach as opposed to a rifle approach. And I think if we just spread it in a shotgun way, it would trigger a lot more reaction and just help to diffuse some of the deleveraging that's going on in the economy.
Do you think we'll actually get some sort of language on this week? You mentioned the minutes before the break. Are we going to have to wait a while to be able to get a decent look into what the Fed was thinking here?
I think, to go the route where you would actually go into to reinvest in Treasury purchases, that would be, pretty dramatic and pretty forceful, and that might surprise markets without, preparing them appropriately. So if you had a chance to just describe. Exactly, not Bernanke style. So if you had a chance to convey the signal in the minutes and so on, and have some speeches and testimonies along the way, that would definitely prepare markets, set things off in the right way, and that would be more consistent with the way Ben Bernanke conducts policy.
John, give us your outlook for growth. I mean, Ben Bernanke has said, I thought quite interestingly, that incomes will continue to rise and that will prop up consumer spending while the unemployment rate remains a problem. Do you agree with him on that issue, that will hold us back from a double dip?
We've been fighting the chairman on this point for about 3 or 4 months now, and we think basically we're in a sort of lackluster jobs recovery and a lackluster income recovery. So we would tend to disagree with the chairman. Our view on GDP is we're looking for about 2% growth on average over the next 4 to 6 quarters. That's well below the Fed's target of 3 to 3.5%, and well below the street consensus is around 2.8. So we would disagree with the chairman on this point.
Looking through some of your forecasts, you talk about the weak private sector, slowing growth, the stimulus expiring, continued housing problems. Where do you see sources for growth? Where does that 2% come from?
Well, we're seeing it actually. We continue to see some signs in exports, but CapEx remains a phenomenally strong sector of the economy. So spending on equipment and software is just very, very strong. The recession there was extremely deep, and as we can see from the latest rounds of earnings reports, business balance sheets are very, very strong, flush with cash, and ready access to credit markets, very low borrowing rates, extremely low interest expenses. So we just continue to see that as the source of power in the economy.
And you don't see then a contraction in 2011?
Right now it's a little tricky. It's a little bit, I would call it data dependent, that view. But at this point, our baseline case is still that we're seeing a growth compression, a growth around 2%. This is lackluster. This is below potential. This is soft. This is not enough to materially bring the unemployment rate down. And actually, over the next 3 to 4 months, we could start to see the unemployment rate start to drift higher. And that's basically what's going to be my take.
And you see that driving yields on the 10-year down to 2.5, 2.5.
I think it could embolden investors to push those rates down towards 2.5, and I think especially should the chairman make any kind of mention that QE is going to go into Treasury markets, then you're definitely looking at 2.5% in the 10-year and possibly lower.
All right, John, let me just ask you real quickly, and I mean, you may have answered that, but long term, do you see interest rates on the long end of the curve becoming a problem for this economy?
No, because what would happen is this: in the intermediate term, if we do get this form of QE, if we do get the Treasury-based form of QE, then I think what we're looking at is the entire curve would catch a pretty strong bid, and that would basically it could potentially flatten the 5s30s portion of the curve. It would definitely set off a wave of buying on the back end of the curve, and even the next week's auction, the 30-year bond auction, we actually think could possibly go very well.
So even if many mortgages aren't being created, you expect rates there to stay at record lows?
We expect them to grind in and grind lower.
All right. Hey, John Herrmann, thanks so much for joining us. John Herrmann there from State Street Global Markets, a Bloomberg best.